kids can't afford houses. The housing price has gone from $200,000, $215,000 2 years ago to $400,000 today. I have 7 kids who are in the range 20 to 35, and almost none of their friends are buying houses. That was part of the American dream, that if you worked hard, you played by the rules, you could afford a house, you could take a summer vacation, you could raise a family, put money aside for retirement, and that was with one job.
A big part of the American dream is owning your own home. But with rising housing costs, this dream is becoming more and more elusive. But have you heard about the new 3% mortgage, fully backed by the American government? Robert F. Kennedy Jr., a 2024 presidential hopeful running for the Democratic Party nomination, is proposing a plan where Americans can get a 3% mortgage backed by the government. He says it will be like having a rich uncle. Uncle Sam. He says he will be able to offer this without raising taxes and without increasing the national debt. His plan? To offer tax-free government bonds to investors to help them raise the money. A tax-free government bond gives an investor the opportunity to earn interest on their investment tax-free. If you were to buy a bond today, or even a stock from the stock market, and sell it next year for a profit, you would have to pay taxes on that profit. But that's different for a tax-free government bond. The profits that you earn from this investment are tax-free, which obviously gives investors extra incentive to purchase these bonds. But is this going to fix the problem with affordability that we're currently all facing in the real estate market? In the last few years, the median home price in the United States has gone from $250,000 to over $400,000. On top of that, mortgage rates have soared from 3% to now over 7% on a 30-year fixed-rate mortgage. Since last year, mortgage purchase applications are down 28%, which is not a surprise because of the current mortgage rates. Most people have been priced out of the market. While a 3% mortgage rate would make home ownership a real possibility for many, it doesn't address the root problem in the housing market at this time, which is lack of inventory. Many homeowners out there might be looking to upgrade their home, but they can't because they have a great interest rate locked in. If they were to sell their home and upgrade to a better home, they would have to substitute their current 3% mortgage rate with a 7.5% mortgage rate. That doesn't make sense financially. This year, we will have the lowest number of real estate transactions since the 2008 housing crisis. The lack of transactions isn't due to lack of demand, but due to lack of supply. The current months of inventory in the US is 2.8 months. A balanced market, we typically see 4 to 5 months of inventory on the market. The months of inventory number is unchanged from last year, which isn't surprising because interest rates have caused demand to go down, but demand is still outpacing supply. There are more people hoping to buy a home than there are people listing a home. This is why we have home prices up year over year. According to Redfin, pending home sales are down 13.3% since last year. New listings are down 9.3% since last year. Inactive listings are down 18% since last year. So although the interest rates have pushed many to the sidelines, the homes that are being listed are still getting purchased. RFK Jr. argues that big investment firms like BlackRock, Vanguard, and State Street are buying up residential properties and pushing ordinary buyers out. How can we, an ordinary buyer, compete with an all-cash offer from BlackRock with assets under management of over $10 trillion? That is more than the entire GDP of the state of California, which is the world's 4th largest economy. According to this figure, we can see that as of Q2, 34% of homes in California were owned by investors, 33% in Washington, D.C., 32% in Georgia, 31% in New Mexico and Texas, 30% in Nevada, 29% in Utah, Arizona, and Kansas. They also say that though the data shows the usual summer dip in home investor activity, there are no indicators that it will regress to pre-pandemic levels of less than 20%. Elevated interest rates and slowing appreciation seems to have dissuaded large and mega investors, while small investors have stepped up to fill in the gap. So maybe it's not only BlackRock, Vanguard, and State Street buying up residential properties. There's smaller investors out there too buying up second or third homes that can possibly cash flow. It's a great investment if you have money sitting on the sidelines. I see where RFK Jr. is coming from. He's trying to give Americans an opportunity to compete with big investors by lowering their mortgage rate. And yes, this would make mortgages a lot more affordable. They would make mortgages on average about $1,000 cheaper per month. We would have thousands of Americans with their new pre-approval in hand with a 3% mortgage rate, flooding the market, looking at the very few homes that are actually listed. It's simple economics. If you have more demand than there is supply, prices are going to continue to go up, which is why prices have gone up since last year. Demand is still outpacing the supply. Although demand is down quite a bit, the supply is down even more, which is why prices are continuing to go up. Even if the 3% mortgage opportunity was also afforded to current homeowners so that they could upgrade to a better home, that still wouldn't fix the problem. You see, when a current homeowner wants to upgrade to a better home, this actually doesn't help the inventory side of the equation. Although they are selling and putting one more listing on the market, they are also buying and taking one listing off the market. As a part of RFK Jr.'s proposal, I would like to see extra incentives for home builders or extra incentives for people to sell their second or third investment properties or vacation homes. Maybe the government can offer tax incentives, for example, so that homeowners who sell a second home or a vacation home can sell that property without being taxed on the equity that they have gained since they purchased it. In the recent Federal Reserve Open Market Committee, they decided that they were going to leave the current federal funds rate where it's at, but they left room for an opportunity to continue to hike rates in the future. Rates are currently holding steady at a rate of 5.25 to 5.5%, but they expect to hold those rates higher for longer. By the end of 2024, they are forecasting rates to be between 5% and 5.25%. And by the end of 2025, they expect rates to be between 3.9% and 5.1%. This is all going to depend on the inflation data that we see as it comes in. If the rate of inflation continues to go up, that is not going to be good news for mortgage rates. But if inflation does start to come down, that will be good news for mortgage rates. Because when inflation starts to come down, that means the Federal Reserve can lower their federal funds rate, which ultimately impacts the 10-year Treasury yield, which ultimately impacts the 30-year fixed rate mortgage. Although many buyers have sat on the sidelines waiting for a coming housing market crash, economists say that that is not going to happen anytime soon. According to Lawrence Yun, chief economist for the National Association of Realtors, a crash happens with oversupply, Yun says. A 30% decrease will not happen because there isn't enough inventory. He believes the housing supply will balance out within 5 years. Many other experts agree that there is no danger of an imminent housing market crash. Not only is inventory too scarce, but lending standards today are much stricter than they were back in the days of the Great Recession. Lenders are largely not issuing loans that borrowers can't really afford anymore, which helps keep foreclosure rates low. According to the California Association of Realtors, they expect home prices to rise 6.2% in 2024. They say first-time buyers who were squeezed out by the highly competitive market in the last couple of years will try to attain their American dream next year. They also say inflation will continue its gradual decline over the next 18 months, with the CPI registering at 2.6% in 2024, down from 3.9% in 2023. Housing supply in 2024 will remain below the norm despite a projected increase in active listings of between 10% to 20% as market conditions and the lending environment continue to improve. So as we can see, home prices are expected to continue to go up. If home prices continue to go up just 3% per year over the next 3 years, the amount of money that you save on the interest rate being lower at that time wouldn't cover the amount that you would save if you were to purchase a home now at a higher interest rate. Many buyers who can afford to buy a home now understand this. And although there aren't many homes to choose from, they still are looking because they don't want to miss an opportunity to buy a home at today's prices. Although the interest rates are high and their mortgage rate is going to be high also, they are cutting expenses elsewhere to help cover the costs. You see, if home buyers wait until the mortgage rates finally do come down to say 5.5% or 5%, in that scenario, there's going to be a lot more competition for you to get the home that you really want. And more competition means higher home prices. We saw that in 2020 and 2021. The number of listings was very low, but the demand was very high, which caused home prices to explode. Everybody was trying to get a home while the interest rates were at 3% or even lower. At that same time, there were also many people looking to upgrade their home. But again, like we talked about, that is just a 1-for-1. So that did not help the active listings on the market. If Robert F. Kennedy Jr. is elected, he would be inaugurated in January 2025. It's possible the economy and the housing market could look different at that time. But if we're still facing similar difficulties with lack of inventory, then his proposal is going to have to take a deeper look at the issues plaguing first-time home buyers in today's economy. So if we want to help make homes more affordable, yes, a lower mortgage rate obviously helps us do that. But a lower mortgage rate for more people means more competition. More competition means higher prices. So hopefully we can find a different way to get more homes on the market. That is all for this video, everybody. Thank you so much for stopping by. I'm Ryan Mossman. I am a real estate agent in Southern California. If it's your first time here, please subscribe to the channel, like the video, and comment below. Let me know what metro you're looking to buy a home in.